So my job is to set the scene about emerging markets and what we've seen in the past and how to look at it. I've been involved in EM for a relatively long period of time as a macro investor. And I've probably gone through an evolution of how I think of the markets as you do. Here's a traditional approach. You think of it in terms of countries. Emerging markets are the BRICS, or they're Latin America, they're Asia. And that is still, I think, a good way to think of it, though, as the speaker from earlier this morning mentioned, that increasingly on a forward-looking basis, the real opportunity is to realize that these markets are not homogeneous, that, in fact, the opportunity for diversification within and across the sector will be something that really sets many of these markets apart, and the dispersion of returns across countries is something worth noting. But is there another way to think about it? Well, I think we all have a sense we invest in these markets because they're high growth markets relative to the developed. And again, taking into account what the speaker mentioned this morning, we do invest or chase economic growth, sometimes at our peril, because it's not always aligned with capital market performance. In the developed markets, with appropriate leads and lags, there is obviously more of an adjustment because economic growth inevitably leads to earnings. But in the emerging markets, much of the capital markets that you can invest in are a relatively small percentage of the economy. The real opportunity is often in the private economy and not the capital markets. So that's something to take into account. The inflation differentials are also worth noting. It leads to the next page. Right, so I'm sorry, just to be clear for those who are in the back, the blue charts, the blue bars are the emerging world, and the green is the developed world. And so in both the case of economic growth historically as well as inflation, you see that differential. So with the higher growth of the emerging world, you're obviously getting higher inflation. And that leads to different central bank policy, different yield curves. So those of you who are involved in the global debt markets, that difference of opportunity set is an opportunity. Low rates available via the ECB or the Fed policy or the Bank of Japan policy are not replicated elsewhere until recently. Major markets like Brazil were actually in the middle of a tightening policy, not easing. And so that's another way to think about the emerging markets. Where are they in their interest rate cycle relative to the developed world, where increasingly we've seen higher correlations. And I think as an investor, as a multi-asset class asset allocator, I'm looking for any time I can get a lower correlation, but in an asset class that gives me what I want: capital appreciation, income, risk mitigation against long-term inflation. Are there multiple ways to achieve a common goal, a common portfolio solution, but with more efficiency, higher Sharpe ratios, and the key to that is of course, lower correlations. Is it demographics? We actually spend a lot of time at Northern on demographics, especially when it comes to our strategic investing. Annually, we retreat to conduct what we call a capital market assumption review. That's when we update our long-term numbers. And there's admittedly a bit of an oxymoron. So annually, we update long-term numbers. We don't make major adjustments, but we think the world changes enough. You just can't set and forget your long-term assumptions over the long term. They have to be revisited because the world changes. But what's nice about demographic trends is that when you're dealing with large population bases in particular, they're fairly inexorable. While these are very long-term forecasts, hopefully I'll be around, well, maybe in 2050. I'm starting to run against Father Time here. But I think it's fair I have a lot of confidence that these numbers will, in fact, be realized. And just look at some of these. Starting with the top, the estimated population change for India. 1.25 billion people there today, going to 1.7 billion. That's another 500 million people over the next 35 years. So the US today has a population of just over 300 million. So that's over 150% increase of the US population taking place in taking place in India. So think about the opportunity, the growth in the working population, and you can see in the bottom that implies for them a very attractive dependency ratio. Dependence ratio is the percentage of your population over the age of 65, less than the age of 15, divided by the remaining population. And so do you have a lot of work or supporting people who are no longer working? That's attractive in India. but also then think about the demands on infrastructure. For those of you who have been to India, you probably can't imagine another 500 million people being in any of the major cities or spread about. And think about the demand on water. Many of these emerging markets already struggle for access to fresh water, and so population change will present a risk and an opportunity for those who help address that problem. But the point being is, when we think about EM, I think many of us think about this sense that they're different demographics, and that's what makes them different from the developed markets. They're younger populations, they're growing workforces, but you can see on the bottom, that's not necessarily the case. Russia being the most extreme example, where the dependency ratio is just as bad as anything we see in a Western European country, and the actual population is expected to decline. So to generate economic growth, and economic growth basically is a function of change in working population and productivity increases. So if your working population is declining, that puts huge pressure on productivity increases to generate GDP growth. And so that's going to be a challenge. So even on the demographic front, we have to be a little bit cautious about generically defining what makes an emerging market. But speaking somewhat financially, the main reason we're interested in emerging markets as investors is we think there's a greater opportunity. They generate higher returns. And if you look at this chart, that is indeed the case in the long run. That top red line, or dark orange, hard to tell, but the one that's demonstrably higher, has clearly outperformed its brethren across the developed world, Europe, United States, Japan. And it's maybe a little bit difficult to tell, but more or less you can see that from 2010, it's been more or less range trading. In fact, that's been one of the great disappointments as a macro investor who would have expected emerging markets, because of these overall macro trends and what we thought were compelling valuations, to outperform over the long run. And I don't know about you, but in my business, 5 years is kind of a long time. And so the underperformance of EM over the past 5 years, and in particular in 2013, was probably one of the outliers. In 2013, emerging market equities underperformed the US by over 30%. And so even a relatively small spread trade generated huge underperformance if you got that wrong. In the long run, if you're a strategic investor, maybe you can see through that type of underperformance, but it's hard to have a miss like that. It's hard to explain that, and it's an opportunity loss to underperform a major set of markets, so one up 30%, the other one more or less flat. That's very painful. Maybe it's attractive valuation. Many of you probably hear that emerging market equities are cheap, and that's what makes them distinct today relative to the developed markets. Lots of data here, but I'll just focus on a few traditional valuation metrics. On the far right, you can see the data for the emerging markets relative to what we have in the US and the world ex-US. And if we just go straight down the price to cash flow, one of my preferred valuation metrics, you can see that EM has a price to cash flow currently of 8, okay, versus the US of 12. So in that relative current world perspective, that's attractive for sure. And relative to its long-term average, so if you compare EM to itself, 8 versus 8.4, relatively attractive when you compare the US on a price to cash flow basis, 12 versus its long-term medium of 9.4. So certainly the valuation indicators make emerging markets different relative to what you find in the developed markets. But as we'll see, you have to dig a little bit deeper into the data because there is differentiation across the emerging markets, and much of that valuation is driven by state-owned enterprises. So when you hear people say, well, EM is cheap relative to the developed markets, really what they're saying is state-owned enterprises are cheap. Because once you strip those out, that valuation discount disappears materially. This is one of my favorite charts, and I know you probably think it's impossible to read. It's almost borderline Aboriginal art. But it's actually something I love to do with clients, and I'll be able to walk you through it very simply. It really shows the volatility dispersion across markets from a multi-asset perspective. All you need to do is start and follow where that arrow is, which is hiding that light blue a box. And that's emerging market equities, which in 2004 returned 25.6%, the second best performing asset class. And here you see we have global real estate, that's the red at the top. That was a great year for real estate in 2004. Going down, emerging market fixed income and so on, all the way to cash. And cash at 1.2%. And then, just by way of reference, the black chart, the black box rather, is a 60-40 portfolio. So it pays to be diversified across asset classes if you don't want extreme volatility. Because you can see the 60-40 portfolio more or less comfortably stays in the second or third quartile. But look at EM. But if you want an exciting ride in the markets and you want all in, EM's the way to go. But it also highlights the danger of chasing return and not being appropriately diversified. Okay, so this is what happens often in the markets, and certainly we have a very large high net worth business to complement our institutional business, and the individual market is very guilty of this. So EM, second best performing market, up 25.6%. That starts to generate interest. Another year, 2005, best performing market, 33%. Now the popular press is onto the story. People start getting into the market. 2006, they're feeling really smart. They made an allocation to emerging markets. They earned 32.2%. 2007, now they're all in. Now they're saying, I'm really smart, I'm chasing this return. They're fully invested. And at the point of maximum exposure, what happens? The following year, they lose half the value. So I always find this ride through emerging markets very interesting because it just highlights the importance of understanding volatility, contribution to risk, and are you getting paid for a single risk versus can you diversify it away and have the best of both worlds. The long-term return that's available via the previous chart, but mitigating the volatility by getting exposure to the other asset classes as well.
I will try and take the emerging markets from the trees to the forest and do that in less than 12 minutes. Because what we have discovered today is that there's been a lot of emphasis throughout the talks during this morning and this afternoon as well on complexity. That was one of the words that the very first speaker liked a lot. And complexity is for sure a characteristic that we all have to deal with every single day. There are just more things that we don't know than things that we know. But one thing that we do need to take into account is that it's always better to look at two competing ideas, explanations for what's going on, and take the simplest of them. So we don't actually have to look at the world in a very complex fashion to draw conclusions. And this is an example of that. So why do we actually own EM? Why do asset owners go in and invest in emerging markets? And there are a whole litany of reasons why we do that. Of course, expected return. There's expected diversification, so we like that diversification element of it, together with the return. Maybe larger opportunities for active management. Maybe we just happen upon emerging market exposure through our private deals in infrastructure and so on. We may have given managers a developed market benchmark, but allowed them a little bit of leeway to go into emerging markets, and suddenly we see a lot of off-benchmark bets in emerging markets. Some of us have liabilities in EM, and it's a good hedge for those liabilities, because we've been told that that's where the future lies. This may or may not be true. Some of us has been told by consultants, advisors, and boards to do so. And then, you know what? The next guy is invested, so I'd better follow him because he's smarter than I. So with that in mind, I have a very simple spoiler alert, and basically from now on you can kind of sleep if you get this. EM benchmarks, they all look attractive on a risk-adjusted basis, on a backward-looking basis. And that's true to a varying degree, but that's basically how it is. However, all EM benchmarks are basically correlated across asset classes. So if you're looking at doing a EM debt investment, you're looking at doing an MSCI investment, in reality, you're doing exactly the same thing. So keep that in mind as you believe that you're chasing diversification. Also, EM investments are actually dominated by global investments risk. So depending on the best benchmark that you are in, a lot of the risk and return from EM investments are simply coming from S&P 500 on the MSCI side and WGBI on the debt side. So you're getting a lot of global risk in your investments. Now, this is actually not necessarily a problem. This may actually be a comfort in the sense that EM, at least these days, they're not that different from your other investments. So this idea that EM investments are oh so dangerous may be a thing of the past. Then my last conclusion and my last comment is that the idiosyncratic or the part of the risk that cannot be explained by other factors, but is EM specific, can to a large extent be captured through the currency component. So for those of you that thought you weren't currency investors that have EM exposures, lo and behold, you are. Now, these are just some numbers to get you some ideas of what's going on. And these are just some numbers from when EM benchmarks really started to evolve and when EM markets in general were beginning to catch some attention. And these all have pretty impressive return to risk ratios. You can find better in some developed markets, you can find worse in some developed markets, but they're all pretty good, on the order of about 1. You also see that they all come with nasty distributional characteristics. They're not anywhere near this nice normal bell curve that we like to invest with, but we hardly ever get. So this is the same picture again. These are the EM indices over time, and there's one particular index that looks as if it's outperforming all the others, which is basically the MSCI EM, so the equity index of the lot. Now, my colleagues back at home say that you should never ever show a graph like that. You should always show log returns, because basically what you are ignoring here is the variability that you see in these returns in the very early days of these indices. So you're actually cheating a little bit with graphics here, as they say, lies, damn lies, and statistics. So MSCI EM needs to be the way forward. Not so fast. One of the drivers of the MSCI outperformance is just the fact that they're more risky than the other indices. So if you basically do a backward-looking exercise and then put all these indices basically on the same risk scale, then you actually get a different picture. And you get the picture that the MSCI EM, on a risk-adjusted basis, is actually the poorest performer of all these indices. And you would have been much better off in any of the other indices. Now, you also think that debt investment doesn't come with the drawdowns that equity investments will normally have. But just look at the MB index, which is a debt index, and the left skew that particular index has, or that left tail that index has, that drawdown that we get during the temper tantrum, that is dramatic, of course, not something that anybody else will have. And on a risk-adjusted basis, it just shows you get the same returns characteristics as you do with equity. Why is it that MSCI is so relatively poorly performing? Well, if we go back to the previous table here, right, you can see the return, or the return to risk characteristic. This is the lowest of them all, and it's the power of compounding. So we also go and then we basically look at these indices, and as I said before, we think that we're getting different stuff. When we invest in the debt portfolio, we think that we get different stuff when we invest in the equity portfolio. But wait a minute, these are all highly correlated. So whether you invest in ELMI, whether you invest in EMBI or TBI-EM at the forest level, then you basically get a whole lot of the same risk, a whole lot of the same correlation as you basically do when investing in MSCI EM. The correlations to your S&P 500 portfolio, or whatever your equity benchmark would actually be, it doesn't really matter, is also significant and the same across all these asset classes. So no wonder that your fixed income guys like emerging market debt. Why do they like emerging market debt? Because it diversifies a fixed income portfolio. But what about the overall risk for the plan? That's the question. So as you add on EM debt into a debt portfolio and think that by that you are getting more debt exposure in the portfolio, you're not. You're getting more equity-like portfolio. But wait, as they say in the commercial, there's more. If we're looking at explaining the variance of these different indices, then there's basically one driver that explains most of the difference between these indices, or rather one particular driver that explains the, in this particular instance, the variance here. And what I've done is that I've done a technical term for it. It's a principal component analysis. And basically the first principal component, which is the main driver, drives about 70% of the variance in all these indices. Now, it doesn't tell you a lot, just tells you that there is something that drives the return on risk of these particular indices that is the same thing. Don't know what that thing can be. That's a problem with principal component analysis. What could it be? Well, I did something complex. I just threw a whole lot of different factors at the EM indices. And lo and behold, it came up with not S&P, not oil, not VIX, not gold, as the main explanatory variable. It came up with emerging market currency. So the main driver of the special nature of EM indices is basically the currency risk. And you didn't believe in currency investment. Well, it gets even better. If you take it a step further and then look at how can I recreate the particular index exposure that I have with a combination of EM currency risk and an appropriate underlying benchmark, is that even possible? It is possible to an amazing degree, in the sense that if you invest in EM currency risk and appropriate indices, like WIGBI for ELMI, EMBI, WIGBI again, GBI EM, WIGBI again, and MSCI EM, S&P 500, then you get basically EM exposure at the index level. So currency plus S&P 500 gives you MSCI EM. The correlation, or rather the R squared on it, on that one, is 80%. That means there's only 20% of the MSCI EM index that I cannot explain by these two variables, one of which is a global variable. So what to make of this? So again, remember why we own EM? Return, diversification, large opportunities for active management, and so on. Well, returns are there, for sure, but the main drivers are global. Diversification is there, but you've got to watch your fixed income allocation. You're doubling up on equity risk if you think that you're putting it into that particular bucket. You cannot ignore currency risk or the returns that are coming from the currency component when you invest in emerging markets. In that sense, it's the tail that wags the dog.
Let's have a bit of a history lesson in terms of the last sort of 15, 20 years. So this chart here, all it's showing is the degree of similarity between business cycles in emerging markets compared to those in developed markets. So if the line is rising, all it's saying is that business cycles are becoming more coordinated, more synchronized. So basically in the early to mid-2000s, there was a big influx of capital into emerging markets, benign economic environment globally, liquidity was quite abundant, and basically all the emerging markets actually acted very similar to developed markets, at least in a growth sense, and also they acted very similar to other emerging markets as well. So there was no real dispersion, if you like. In fact, quite the opposite. And that's important because it then spilled over into market returns. This chart is exactly the same. It's showing the average correlation between market returns, equity market returns, this is. So really from virtually zero in 93 to nearly to sort of 50% just around the GFC. One of the arguments for owning emerging markets, which is their diversification, sort of disappeared. And actually, as an investor in emerging markets, you didn't really need to make too many country decisions because they were all moving fairly similar. a large part of that was a currency return as well. I mean, currency, Yappy picked up on this earlier on, that currency movements and market movements are very highly correlated in emerging markets, and that's probably because of the capital inflow effect that you see there. But we sort of, if you think about the last 3 years, we've seen a return to sort of a more diverse sort of a period of returns. Correlation's been falling, and I think that will continue. If you look at this chart here, this just illustrates performance of country return, equity market returns over the last 3 or 4 years. I don't know if you can see the countries are there, but they're split by region, and there's US dollar and local returns. So the scale on this chart is quite wide, and even between markets like China and Brazil over this period, the spread was about 40% in performance terms, and that's, it's huge. A small position either way would have had a massive impact on your returns, and you didn't see this in the 2000s before. It's a more sort of recent phenomenon. The second point of this chart is interesting, is that the difference between the USD and the local currency returns, and that if you look at South Africa, Brazil, India, big differences between whether you hedged a currency or not. And this next chart just makes the same point. It focuses on the fragile five currencies, which I'll come back to why they're called that in a moment, as well as Russia and Argentina. So this is just US dollar cross rates against those currencies since the peak of the market in December 2010. So some of the declines there are absolutely huge. And this is, once again, didn't happen in the sort of the 2000s. You had positive carry there. Markets were going up, and the currency was a tailwind. What we've seen over the last 3 years, with the exception of this last 9 months or so, was a double whammy. You lost on the market and you lost on the currency. And so, why does this happen? I mean, generally, if I'm arguing for wider country dispersion in emerging markets going ahead, it's that these countries are all now coming into a much more difficult phase of economic growth. They've had the easy money, the global growth environment was supportive. Now they're facing the structural problems, and they're all going to deal with those problems at different paces and with different levels of commitment. And that's what is going to drive a lot of this dispersion sort of going ahead. And currency performance is, as I said, the clearest manifestation of a financial crisis, if you like. Other examples, a sovereign default or a banking crisis. So I thought it would be useful to look at market returns around sort of previous financial crises, just to give you some idea of how we should approach it as an investor. So this is an event study. It's using countries, including developed markets, back to 1972, so there's about 50 countries in here. And it looks at performance of the equity market before and immediately after a financial crisis, and as you can see there what type of crisis I've defined as. So there's two things that are interesting here. One is that by the time the crisis occurs, whether it's default or a bank being bailed out or a big depreciation of the currency, it's too late. You've already lost, from an equity market point of view, you've already lost your money, and the numbers are huge, as you can see there. The second point is that actually, generally it's a buying opportunity. Once the crisis happens, you should be sort of piling in, particularly if it's a sovereign default, because quite often there the IMF steps in and sort of gives you a slap, and your currency is normally weakened, and there's normally a sort of a glide path back to sort of accessing global markets again. So the recovery in the equity market is actually quite good. Banking crisis, because of the interlinkages between the real and the financial economy, the recovery there is slower, and that's the experience that we've seen in Europe recently, in Japan in the 90s. So the question is, can we forecast these things? And this is my basic view as once was an economist and sort of grew out that phase, but is that you shouldn't forecast anything. And this chart here just shows the frequency of the words financial crisis on online news articles going back to the early 90s. So if you look at the period just before Lehman's going bust, literally to a few weeks or a few months before that happened, there was very little discussion in the popular press about what the sort of the calamity that was to follow, and not many forecasters got it right, as you know. So if you can't forecast these things, then what do we do? And the good news, I suppose, is that we don't often know what the catalyst is, but we can forecast the vulnerabilities. And going back to the earlier chart about a lot of your return is destroyed in the build-up to the actual crisis event. So forecasting, or measuring rather, the vulnerability of countries is actually really important, and actually it can give you a good head start. This chart here. Excuse all the mnemonics there, just currency codes. But on the left-hand side, you've got the performance of developed and emerging market currencies ranked against the US dollar, ranked by whether they're high risk or low risk. And on this, we're defining risk in this sense as basically currency credibility, competitiveness. So going back to those fragile 5 economies earlier on, Brazil, India, Indonesia, Turkey, and South Africa, they were all marked by the market as being vulnerable because they were the ones with the biggest current account deficits at the time. And that's the current account deficit is probably the easiest measure of sort of external, or how in hoc you are to external support. So that was a number that the market focused on, and that's broadly what this currency risk sort of is telling us. So given the downward sloping line, what it's actually describing is that the market was quite rational in 2013, which was, as Bob and Jeppe referred to it, which was the disastrous year for emerging market investment. It was a repricing of risk. These currencies were risky, or these countries were risky, and the market sort of reacted accordingly. And on the right-hand side, you can see the equity market return, and so a similar sort of performance there, with the only outlier being Egypt, which obviously went through a political upheaval twice around that time. And interestingly, in this year, and this data only goes up to July, it hasn't been the case. Risk hasn't really been priced in the currency market, and if anything, in the equity market, on the right-hand side, you see a slight upward sloping line, and that's basically saying that some of the cheaper, riskier markets actually have had a bit of a bounce this year. If I now updated that to today, it will probably be downward sloping again, because over the last month or so, sort of markets become a little bit more risk averse. You've seen the Russian sort of Central European bloc sell off, like the Poland and Zloty and Hungary and Florent have sold off, along with the ruble. Turkey's coming into now post-elections has got its own economic problems, and the lira has been falling again. So it's the reason we're talking about this is because basically you sort of look a little past few years and you think, well, maybe that's normal. This is what's going to happen from now on. We're going to see risk periodically priced or not priced by the market, and that's the essence of investing in emerging markets, knowing when to sort of whether the risk is valued or not. So the title of the session was is it the end game for emerging markets? And I would say in a word, yes, but in a sense that I don't think emerging markets is a homogeneous, coordinated sort of asset class with positive growth and positive carry on the currency side is really going to be the norm going ahead. And from an investment point of view, I think we need to be prepared for more dispersion, which is an opportunity and a risk. It's really the only out of Jeppe's list of 9 reasons to own emerging markets, that was the one that sort of struck me as the argument for owning them today, is that you have got this volatility, but also with it comes some risks. And I hope in the last 10 minutes or so, I've just sort of highlighted some of those ones that we've got to keep an eye on, particularly that currency management.